Are you an established small business owner or aspiring entrepreneur? Would you like professional advice to help your business grow and succeed? Well, look no further. The Virgin Islands Small Business Development Center is the territory's #1 resource to move your business forward. Enjoy no-cost advising, low-cost training, and technical assistance from experts in both the public and private sectors. The VISBDC is nationally accredited and sustained by the University of the Virgin Islands and the U.S. Small Business Administration. Visit us at our locations on St. Thomas, St. John, or St. Croix, and follow us on social media at VISBDC. For easy access to all our training and networking events, be sure to join our newsletter and download the VISBDC app. The Virgin Islands Small Business Development Center, here to help your business start, grow, and succeed.
Good morning, everyone. Thank you for joining today's session, the 5C's of SBA Loan Eligibility. My name is Sharika Industrious Phillips, and I am the Network Marketing Coordinator here at the VISBDC. Let's skip the fluff and start with a quick reality check. If you have ever looked into getting an SBA loan to grow your business, buy real estate, or acquire another company, you've probably felt completely overwhelmed. The paperwork looks like a mountain, the rules seems to change constantly, and it feels like banks are speaking an entirely different language. If you've ever thought, my business is successful, so why is it so incredibly hard to get approved? You are in the exact right place. To help us navigate this, I'm honored to introduce our presenter for today. He is a dedicated advocate for small businesses across Puerto Rico and the U.S. Virgin Islands. As the SBA Senior Area Manager for the USVI, he has helped countless entrepreneurs access the capital and the confidence they need to compete. Please join me in welcoming Wayne Huddleston. Here's a friendly reminder to place your questions in the chat, and they will be addressed by the presenting team either directly in the chat or later during our question and answer segment. A copy of today's presentation will be attached to the post-survey email sent after today's live session. We encourage you to take a few minutes of your time to briefly fill out the survey that lets us know how we are doing. This data is essential to us rendering these deliverables complimentary to you. So without further ado, Wayne, the floor is yours.
All right, good morning, everyone. Thank you for joining this presentation today. As Sharika said, we're going to talk about how to secure a loan for your business. It's not necessarily an intuitive process. There is a sort of language that lenders speak, and there are specific things they look for in a loan that aren't always obvious. So we're going to talk through what those are, and those generally boil down to something we call the 5C's, and I'm going to talk you through all of that today. Okay, so the 5C's of lending. Here's what we're going to talk about. We're going to talk about the sources of capital. And I'm really going to look at this from a perspective of if you are just starting out a business. Now, some of you may already be in business, but we're going to talk plenty about that as well. I'm going to talk about the different sources of capital that people look at, strictly when they're just starting out in the business. The meat of the presentation today is going to be spent on the 5C's of credit, what that is, how to apply it to your business and present it to a lender in a way that they understand. We're going to talk about government guaranteed lending, specifically SBA lending and our role in the lending process, how you can find a lender, what you'll need before you go talk to a lender, and then technical assistance available. And then only plenty of time at the end to answer any questions you may have. You should be able to unmute yourself or put things in chat. If during the presentation, just put something in chat, we'll get to it at the end. And then, of course, you can answer questions or ask questions at the end. All right. Before we get started, I'm going to show just a short video that talks about the sources of credit, especially from a startup standpoint, just to give you kind of a primer of of what lenders are looking for and how most people fund their business.
Most young companies need money, which may or may not come as a big surprise, but they do. The number one source they get money from is from their own savings, whether it's a few $100s or even thousands of dollars. That's what we tend to tap first. And a lot of companies don't get money from any other place. They get money from their own savings, and then after that, they're lucky enough to be cash flow positive. They're profitable. So we talk a lot as if all companies require all sorts of external capital, and the reality is that more than half of young companies get all their funding from a combination of founder savings and then cash flow from the business, and we're out of here. Next up on the list is another one that catches, I think, people by surprise, and that's credit cards. Almost every young company you can think of, to one degree or another, was funded on credit cards. And it is the single largest source of capital for young companies after founder savings. And then the next place where they tend to get money is from friends and family. After I've tapped out my credit card and I've used up all my savings, I turn to people I know and say, hey, will you help me? And that's the third biggest source of capital. And then the next place is banks. And the banks are a totally weird situation because with banks, they get a lot of attention, but they actually fund very, very few young companies. But it's not their fault. You have to think about the way bank lending works and how shareholders want banks to lend. They want them to lend money against secured assets. And young companies don't have any security. They have nothing to secure it against. And the joke in the industry is you can get all the bank funding you want as a startup as long as you don't need it. And then the last piece is venture capitalists. They get the lion's share of the attention, which in some ways is warranted. You know, your Googles and Apples and FedExes and many others all have venture capital money inside of them. But the reality is, and this is from Kaufman Research, less than 20% of the fastest growing companies in the United States took any venture money. And that's not because the VCs wouldn't give it to them. It's because they didn't want it or didn't need it, because they had all those other sources. I don't need money, and I certainly don't need money on these terms. Because, you know, venture capitalists, unlike banks, they don't lend against secured assets. They give you money in exchange for shares. So they take some of your company away. So my answer is if you don't need it, definitely don't get it. There's no question the venture industry has become staid. The irony is it's intended to fund disruption, and yet it's an industry that had become complacent. And interestingly, over the last 5 or 6 years, we've seen the emergence of other mechanisms for funding, like AngelList, like these kinds of peer-to-peer funding sources, as people increasingly provide capital in smaller amounts, but more people doing it directly. Having said all of that, though, venture capitalists are hugely important for those young companies that don't have access to bank money, but are growth companies. They have the prospect of being a $5 million or a $10 million company in a couple of years, and they need that growth capital to get there quickly. So it's a race. And the way you play the race is by getting money from people like venture capitalists who give you the money so you can compete with other people who are racing as fast as you are. If you can run a company off cash flow and some combination of credit card, your own savings, and friends and family, you know, Bob's your uncle, run. You know, keep all the equity because, you know, there's no better thing than being in full control of your own destiny.
Okay, show that video at the beginning because it does a good job of really showing where most people get their money to fund a business. As they mentioned in the video, a lot of people really think first of a bank, and that's not necessarily the best place to start looking for funding. The vast majority of businesses that are successful and grow, as I said, it's through savings, through credit cards, through friends and family. Banks fund are not necessarily the first place you should go. It's a very tough process. Tough process, and lenders are not eager necessarily to lend to businesses that are new and unproven. They don't want to fund your venture. They want to, you know, help you grow. But they also operate under the understanding that many small businesses, in fact, around 80% of businesses don't make it to the 4 and 5 year point from when they start. 5 years later, 75–80% of those businesses are no longer in business because they couldn't get through that first part. And lenders don't want to put their money on the line for those kinds of odds. So there are a lot of sources of capital that people use outside of lenders: personal funds and savings, credit, friends and family. Those are really the big ones. You can get a traditional bank loan, and we're going to talk about that today, as well as SBA guaranteed loans. But then there are also venture capital, private investors, and those types of sources as well, although they're not as common. This is a little graph that shows where most startups get their funding. As you can see, the vast majority comes from personal savings, credit cards, friends and family. There are some venture capital people who will help out. Sometimes there's angel investors, bank financing, and sometimes crowdfunding. Sometimes people can find those sources online. But the vast majority is personal savings, credit, and friends and family. And that's for startups. Now, as you grow and are no longer a startup, the amount that is financed through bank financing and others will grow significantly as you show that the business is stable and growing. All right, we're going to talk primarily now going forward about securing a loan from a lender and what those 5 C's are, which we're going to get to. Some things to know up front, though. Securing 100% financing for your project is not a realistic option. And that is really no matter what source of capital you're looking for, whether it's someone else you'd like to invest in your business, or friends and family. If you're not putting anything in yourself and you're asking them to take 100% of the risk for you, that's a hard bargain. And banks aren't going to do that. So if you need $100,000 or more, or $1 million, or $50,000, whatever it is, you need to find a way to show that you are putting up some of that amount and not expecting a third party to do it all for you. There are no grants for general business purposes. It's certainly not provided by SBA or any federal agency. Your personal credit history is very important. If you do not have good personal credit, your ability to get a loan is severely diminished. So you want to make sure that you have decent personal credit. A lender is most likely going to require one or more personal guarantees from you, maybe a partner, but you need to be prepared to make a personal guarantee on this as well. And SBA does not make direct business loans in normal circumstances. The only time we do make a direct business loan is if there's a disaster, but that is a totally different situation, and it's not meant for growing your business or starting a business. It's for disaster recovery. And that's a rare time when we do make direct loans. But for regular business purposes, SBA is not making direct loans. We're providing a guarantee. And I'm going to explain that a little bit more in detail later. All right, I want to talk about the meat of our presentation today. This is called the 5 C's. You call it the 5 C's of lending, the 5 C's of credit, the 5 C's of commercial credit. It is a general framework that all lending institutions use to evaluate your loan need and application against their version of the framework. Every institution is going to vary on how they look at these 5 C's and what's acceptable to them for each attribute, but they are all going to look at it. And these are all important aspects of their underwriting and decision-making process as to whether they can give you a loan. So going into that discussion, before you talk to a lender, you should have a good understanding of what those 5 C's are, where your business or your idea proposal stacks up in those 5 C's. And you want to break those down individually so that you can answer questions and be speaking that lender's language going into it. And that will help you a long way. It'll help a lender feel a little bit more comfortable on working with you if you understand what they're going to be looking at and what their needs are. But they're all going to look at them differently. But they're going to look at them, but they just have a different, they may have different experiences on industries or whatever it may be. So we're going to go through each one of these. So the first one I'm going to talk about is capacity, and that is simply your ability to repay the debt. A lender wants to know that your business is generating sufficient cash flow or will generate sufficient cash flow to repay the loan, because the loans are not free. They're not grants. They're not investing in your business. They need to be repaid in full with interest so that they can remain viable as a bank. So they're going to make sure that you can do that. They're going to be looking at your financial statements. They want to see if you generate enough profit, and not just enough profit to pay the loan, but enough profit to be comfortable paying the loan. So paying your salary, paying all the expenses of the business, having a little bit extra set aside for emergencies and contingencies, and paying the loan. So they don't want a paper thin margin there. They want something that's going to be enough that makes them feel comfortable that you're going to be able to pay a loan each month, even if there's a little hiccup each way. They're going to look at your credit score, and that's going to vary by lender. There's no magic number that says, yes, you can get a loan and no, you can't. But if you are below 650, it is not reasonable to think that you can get a loan. So if you have a credit score below 650, before you even think about talking to a lender, you need to improve that score. The mid 700s is ideal or higher. High 700s is great. Mid 700s ideal. Above 700 is what they're going to be, looking for. And when you get below that, maybe they can work with you if there's some situations that are explainable. But then once you get down below 650, you're going to have to do something else. So, and certainly improve that score before you go forward. And then just overall your capacity, just kind of think of this as if you are, getting a personal loan and let's say you want to buy a new car and you want to buy a luxury vehicle that's going to cost a lot of money. And the lender asks you, okay, well, how are you going to pay this back? And you say, I have a job, but maybe your job is only paying $30,000 to $40,000 a year. Well, they're not going to be able to approve your loan. They may be able to approve a much smaller loan, but they need to see what your income is. And that's just the same for a business. They want to see what your income is to show that you are securing an obligation that you have the ability to realistically pay back. Second C is capital, and that is simply the amount of money that you are personally investing. As I mentioned before, no lender is going to be willing to assume 100% of the financial risk for your project or your venture. They want to see that you are putting something in. That's typically going to be at least 20%. Each deal is different. Each lender is different, but they are going to want to see that you're putting something in. Sometimes you can get in with less. Sometimes you're going to say, well, I'm going to need more. Maybe I'll put in half the risk or half the money for you, but they're going to want to see something. So don't go in without anything. If you can get to at least 20%, that is typical. That is a reasonable expectation for a lender, and you can help overcome that part of the C. But you want to make sure that you've addressed that in some way, that you're showing you're putting in some money. The third C is collateral, and these are assets that can be pledged as security for a loan, it really just serves as a secondary source of repayment, so that if you stop paying, the business goes under for whatever reason, they have access to collateral, whether that's a building, whether that's durable equipment or a vehicle or something like that. They're going to want to have that so that they can secure their loan with that. And they're going to discount that to the current value of the collateral and put a realistic liquidation value. They'll be depreciating that over time. But you need to have something to pledge to them as security so that they can, if everything goes bad, they can at least get this. This is not something that they ever want to do. They don't like going through the collateral process because you typically have to go through court system for that. It takes time. They're not necessarily in the real estate business. They're in the making money business. So collateral is not something they like to deal with, but it is something that is essential. They have to have some sort of backup for that. So before you talk to them, you want to make sure that you've addressed what their need for collateral is. The fourth one is conditions, and this is conditions of the marketplace. A lot of this is answered in your business plan. What they want to see is that you understand your business, your industry, the conditions that you're working in, the conditions in the economy, and they want to make sure that those conditions are favorable to your business and that it increases their chance of being paid. They want to make sure that you understand who your competitors are. If you have the type of business that relies on suppliers or other things, supply chain, how are you going to address that if there's any disruption in that supply chain? What trends and issues are you seeing? Are there things that are going to make your business boom and be profitable, or are there things that could hurt your business? And if so, that's fine, but how do you mitigate against them? They want to make sure that you've done all those analysis. And they will, of course, take your analysis and they're going to look at it, but they mainly want to see that you're being thoughtful and realistic in your assessments. They are also going to do their own analysis of your industry and economic conditions in the marketplace to make sure that this is a business or a venture that makes sense to them. And then finally is character. And this is the lender's overall opinion of a borrower's general trustworthiness, credibility, competency, integrity. All of the four other 5 C's the 4 other C's that I talked about are all something that you can change and modify. So for instance, you can secure more cash over time and have that as part of the deal. You can write your business plan or modify your business plan and improve it in ways that show the conditions are being met. You can secure collateral. You can show your cash flow over time. Those are all things that you can objectively show and change. One thing that's very hard to change and is not necessarily a metric in the same way that the other metrics are, the other 5 C's are, is character. It's just a general feeling that lenders have that you're responsible, that you're going to pay your obligations, and gives them a sense of confidence. This is really assessed in every single interaction you have with a lender. When you talk to them, if you say you're going to meet with them, do you show up on time? When you say you're going to provide information to them, do you actually provide it to them and completely? Do they think that you're hiding any information from them? It's often a subjective feeling, but it's important, and it's an important part of that process. I have seen deals that were outstanding in the other 5 C's or the other 4 C's and had their deal sunk because of a character issue, because they either withheld some information from a lender that they found out later that really wouldn't have any bearing on the loan decision, but just the fact that that borrower withheld that information, wasn't being open and honest, it made that lender feel uncomfortable and they backed out and they said no. At the same time, I have seen prospective deals that were somewhat weak in the other C's. I saw one that had a bankruptcy in their past and a few other issues that had happened. They were struggling, but because they were completely honest and they had demonstrated to that lender over weeks that they had continued working with them that they were completely trustworthy. I've seen lenders take a chance based on the character of an individual, and it helps get a loan over the line. So your character is important. Your reputation and community is important. They're going to look at, it's a small community here in the territory. So they're going to look at what you've been doing in the territory, who knows you, what kind of dealings you've dealt with in the past. There's a lot to that. So, but at the end of the day, you can control whether you're honest. You can control whether you provide things that you say you're going to do, and it's just a very important part of it. So if your business is lacking in one of the C's, it doesn't mean that your loan is denied. And that's largely where an SBA guarantee can help. That's where they look to us. And what we are essentially doing is we are taking the federal government's good credit rating, offering that to banks and saying that if you are having a little bit of trouble getting one of these C's to be at a comfort level for you, you can utilize the SBA guarantee. USDA also offers a guarantee for business lending. And then we will say, okay, if that borrower does not pay back the loan or the loan goes bad, we can reimburse you 50%, sometimes up to 90% of the loan, depending on the type of loan, to help that lender out. So if you have 1C, that's really not that sufficient for them. It's not a deal breaker. However, if your business is lacking in multiple C's, it is not realistic to expect a loan or credit approval, even with an SBA guarantee. So, for instance, if you have been in business for a while, your financial statements show that you make plenty of money, that you should be able to approve the loan or pay back the loan. You put cash in a deal yourself, and you have conditions, you're showing your business plan or projections, and all those make sense, but maybe you just don't have sufficient collateral. Well, then an SBA guarantee can help. Or maybe you have sufficient collateral, but you're a fairly new business, and so a business, while you have cash, you have collateral, you have all these other things, you're just fairly new as a business, and a lender is a little bit uncomfortable in that one aspect, then they can use our guarantee. But if you are new as a business, you don't have sufficient collateral, and maybe you don't have enough cash right now, your ability to get a loan is going to be severely diminished and very unlikely. You're going to have to work on those 5C's altogether to make sure you get in a reasonable place for a lender, and at least get them to a point where they can say, okay, I can use the SBA guarantee or USDA guarantee to overcome one of these C's. What I always recommend is before you talk to a lender, just write 5C's on a sheet of paper and then write down what your position and what your proposition is to a lender on that. If it's cash, how much cash do you actually have? Are you putting in at least 20% of the loan? So you want to write that down to see what that is. Do you have collateral? Yes or no? Is it enough to cover a loan? Yes. How long have you been in business? Do you have the financial statements? Those types of things. Just write down the 5C's and assess yourself before you talk to a lender where you are, because they're going to be very thankful that you have thought about this yourself and assess the kinds of things that they are going to have to assess as well. It really helps them in the process. So I mentioned before, our guarantee program, we guarantee a portion of it. Just like with a lender does not want to assume all the risk of your deal, we don't want to assume all the risk for the lender. So we will assume 50 to 90% of the loan, depending on what it is. All the lenders here in the territory can use our guarantee to help them get to a yes on a loan. There are also lenders outside the territory who provide loans here in the territory. Every lender that is in our system that is a certified SBA lender, no matter where they are in the country, if they say, I am interested in looking at deals in the Virgin Islands, you can go into our portal called Lender Match, fill out, I think it's around a dozen questions. They're very straightforward, such as how long have you been in business? How much money are you looking for? How much money do you make each year? Those types of things. When you hit submit, it takes about 10 minutes to do. That will automatically get sent to every lender in our database who has said, we are interested in looking at deals in the Virgin Islands. Once you hit submit, that just goes to the lenders, and then they have the option of replying back to you. We at SBA, we don't really get involved in that. We're just matching your prospective deal with prospective lenders. And if there's a match, they'll contact you. If there's no match, you'll get an email after a couple of days saying there was no match. Here are some resources you can go to. But it's an excellent tool. If you are using Lender Match, I highly advise you to make sure you fill out every field in there, because oftentimes lenders will have filters in our portal to say that if there is no answer in this field, or if it doesn't reach a certain level, then I'm not going to look at it. And so they will just never even see your submission if you don't have everything submitted completely. So make sure you do that. You can just easily find it anytime. If you forget where it is, just go SBA Lender Match, type it in Google, go to the .gov address, and you'll find it on our SBA website. Very easy to use tool. So what's the advantage of a government guaranteed loan? For them, as I mentioned, it just makes it less risky for them because we're taking part of that risk. It's still work. It's still not something that they want to do at all. So they try to avoid approving a loan that has a chance of going bad anyway, but this guarantee does help them out a little bit should it go bad. They'll still lose money, but they won't lose as much. For you, it helps you obtain a loan with perhaps not as much of a down payment or as much collateral on hand. You're going to get decent interest rates. Interest rates I wouldn't say they're necessarily good right now. They're tied to the federal funds rate. So they're not bad. They're not good. They're just kind of there. And they kind of fluctuate. They can be around 10% depending on the type of loan you have. But you're at least not going to get a like a payday type loan that has really high rates, balloon payments, or just an accelerated increase in interest. A lot of those are not going to be allowed under SBA lending. So you can be sure that it's going to be some at least traditional, normal, regulated funding for that. You can just SBA loan for anything, almost anything really. If you want to start your business, to launch it, you're trying to buy a facility, a building, or you're renovating, or inventory, or land, or you just want revolving credit. There's all sorts of things you can use an SBA loan for. Of course, if it's an illegal activity, you can't get a guarantee. If it's an activity that is not necessarily in the public interest, then you maybe not can get a guarantee for that. For instance, like SBA guarantees cannot be used to open a strip club. Strip clubs are not illegal. But the federal government and the public says we don't want to use the public's money to fund a strip club, so you can't get an SBA guarantee for it. That doesn't mean you can't get a loan. Lenders will do it all day long. If it's profitable, they'll do it. If it's legal, they'll do it. They just can't use the SBA guarantee for it. But the vast majority, almost every type of scenario you can think of for a small business can use an SBA guarantee to move forward. As I mentioned, all the local banks can use the SBA guarantee. I highly advise you that if you already have a relationship with one of the local banks, either for yourself personally or through your business, if that's where you have your checking account with the business, you should start there with that lender. Each one of these institutions has a commercial lending officer that would be happy to sit down with you, talk through what your need is, talk about the business, and see what they can do to get a loan. Whether it's, and sometimes they can do it without an SBA guarantee, and that's fine. Then at the end of the day, you just want the money. So an SBA guarantee can help them, but oftentimes they can do it without it. What I recommend is it's always a good idea to just have a good relationship with your lender, whether you need the money or not. It's always helpful to have a lender who knows you before you're asking for money. For instance, it's just like asking a person for money. If you walk up to a stranger, you never talk to them, or maybe it's even someone who knows you, but you never talk to them. And it's not one of your close friends, you don't hang out with them, and then all of a sudden you're going up to them and saying, hey, can I have some money? And can you lend me some money? Well, they're not going to be that inclined because they don't know you very well. But if you go into your lender and you say, hey, I'm not asking for a loan right now. I just want to bring you up to speed about what I'm doing with this business. I have my checking account with you. I have this. Here's how I'd like to grow. What kind of products do you offer? How might you be able to help us as we grow? And just keep them informed on what's happening and maybe not even ask for anything at the time. They will absolutely appreciate that. And they will look for ways to try to help you so that when you do come in to say, oh yeah, I know this person, we've been talking for a while. He shared with me what he's doing with his business. And let me see how I can help. It just makes it a lot easier. So always start with a lender that you have a relationship. Ideally, you've built a relationship with them, but certainly one that you've already have some accounts with or something like that. Another tip I like to provide is don't just start with one lender and go through the process with them, and then if it doesn't work, then go to another lender. If you, let's say, for instance, that you already have an account with Popular and you're at the point where you need a loan, I would absolutely go into Popular, talk to their commercial lending officer, find out what they need, and start pulling together that information that they will need to see for a loan. At the same time, while you're pulling together all this information, almost every other bank here, including any other bank online, will need to see that same information. So if you're pulling it for Popular, you might as well start talking to some other lenders as well. And you can even tell Popular, I'm talking to Oriental, I'm talking to First Bank, I'm talking to Merchants Bank, whatever it may be. Let them know so that when you pull your financial statements, you're sending it to them as well. And then you can go with whoever responds fastest or gives you the best deal. Oftentimes, banks that do not have your business will work a little bit faster and harder to get you your loan decision so that you might move your accounts over. They might say, hey, we can get to this loan decision pretty quickly. Here we go. But can you move your checking account over here? That's one of our requirements. And of course, you might say, that's perfect. No problem. I'll move my account over. So you want to start with multiple ones at the same time and see who goes first and fastest and gives you the best deal. Too often I see people who start with a lender, they'll go through the process for 6 months or more. And then after that time passes, something happens and the lender says, okay, well, unfortunately we can't do the deal. And then you're just starting at square one and you're another, 6 months have passed. So start at the same time. It's just a lot easier. You only have to pull the information once and you can send it to multiple entities and you can see who's more eager for your business. I did talk about Lender Match earlier, so I'm just going to briefly go over that. It is at sba.gov/Lender Match. You go in, you describe your needs. Within 2 days, any lender who's interested will reply. And then you just reply back to lenders and talk to them. And maybe it's a phone call with a lender. Maybe you're emailing them a little bit more information about your business. That's between you and them. And then you apply for a loan. Very easy process, free of charge. Takes 10, 15 minutes of your time. If you're looking for a loan, you absolutely should be doing it. We're going to talk about some things that you will need for a lender to assess. These financial statements are often the number one reason that I hear from lenders that they can't get to a yes on a loan is because a borrower will not provide sufficient financial statements, or they'll come in with just a mess of records that are not well kept or hard for them to go through, and they can't work with that. They're trying to make a reasonable decision on whether they can approve a loan for you, and they need to have a good understanding of what the health of the business looks like, how much money you have on hand, how much money it shows that you make through your income statements and your cash flow statements. These are all very important documents. There are many tools to help with this. There's QuickBooks that can help you put things together real easily in a format that a lender appreciates and can understand. There are accountants who will do this sort of thing for you all day long. Of course, you have to pay them for that, but it is well worth it unless you are able to manage this all yourself. As your business grows, a lot of times you just need to focus on the business itself, and managing the financial reporting and statements on that is a little bit more difficult, but it's very important for lenders. Another thing you are going to make sure you're going to want to know that you'll make sure that you know your credit score going into this. There are 3 major reporting agencies: Equifax, Experian, and TransUnion. It is free to get your annual report. There are apps out there. You can get them even on your phone. There's Credit Karma. There's websites like annualcreditreport.com. There's the Consumer Financial Protection Bureau that can help. There's all these agencies that can help you get your score for free. You can go to myfico.com, purchase a copy of your credit report that it goes through everything. So it's important to know not only what that number is, but especially if you are low 700s or below 700, you're going to want to see what negative things are impacting your credit. So you want to get the full credit report. If there's something on there that shouldn't be on there, you want to make sure you're aware of it and you address that. But you do not want to walk into a lender blind, not knowing what your credit score is and be surprised by what the lender pulls, or have the lender be surprised by what they pull. You want to walk in knowing what that number is. It'll fluctuate a little bit depending on which agency is reporting, but they're all generally close within the same area, and you just want to know what that is before you walk in. As I mentioned before, these financial statements are very important. You can use QuickBooks, you can use a bookkeeper. You can also use one of our partners, the SBDC. They have staff that are very knowledgeable and adept at reading financial statements, looking through your income statements and your projections to assess, are these realistic given these market conditions? They can help read through your business plan with a lender's mindset to understand if is this really answering the questions lenders need to see to get to an approval on a loan? Does this make sense? Or are you just talking about pie in the sky stuff, or are you very realistic? They're not going to create that business plan for you. They're not going to create your financial statements, but they will certainly help you in the creation of those and provide you guidance and advice along the way to help you make sure that you end up with a good business plan that makes sense, very reasonable in its projections and feasibility analysis. This is a free of charge service. Well, SBA pays for it through tax dollars, but it's free to you if you use it as a business owner, and highly recommend that you use them really no matter what, whether you're seeking a loan or you're just in business and you want to think through your long-term ideas and maybe ideas of how to expand or little challenges that you may have with your business. They are there to help. I've been doing this for many years. I've started businesses in the past and been successful. If I was starting another business today, I myself would still go to the SBDC, sit down with some people and talk it through with them just to gather their objective thoughts about my project and what I was doing. So make sure you take advantage of those. There are 3 partners that you can use. The SBDC, who's hosting today, is primarily the biggest one here in territory. They're the most active. They have full-time paid staff that are there for you. They have locations on St. Croix, St. Thomas, and St. John. You can register for an appointment and get more information either by calling or visiting on their website as well. There's SCORE, which is a volunteer organization. The SCORE chapter here in the Virgin Islands is affiliated with the chapter in Florida, which means they have access to many advisors with with a wide variety of expertise in a number of different industries. They can be an excellent mentor for you as you're thinking through your business and trying to grow your business. I've known SCORE counselors who've had a relationship with a client who came in and had an idea for starting a business, hadn't even started it, but just wanted to talk it through with someone. And then 20 years later, their business is grown. They're supporting themselves, very successful, yet they're still every few months or every 6 months or so having coffee with their SCORE mentor, because that relationship has just been that helpful to them over the course of their business. Again, this is free of charge as well. And if you are a veteran, we have something called a Veterans Business Outreach Center. It's located in Puerto Rico, but it is assigned to also cover this area, and they bring down staff to help soldiers who are transitioning off active duty or from the National Guard, but also family members of veterans and soldiers who are interested in starting a business. So that is another tool available to help you. And I kind of went through all these already, but again, the SBDC advisors can do all these things: help you assess the health and feasibility of your business, review your financial statements, provide market industry research analysis, connect you to other experts around, and just really help you develop your expertise. You don't have to wait for this presentation. You can always reach out to us anytime you're thinking through an issue with your business. You can reach out to your SBDC advisor if you have a specific question related to the Small Business Administration, whether it's our guarantee program, our technical service programs, disaster, federal contracting, those types of things at SBA. You can always email me directly, wayne.huddleston@sba.gov. I'm here in the territory. Happy to chat with you at any time, but email is typically the best. That way we can make sure we schedule time to talk if needed, or if I need to introduce you to someone else who may be able to help you on a particular topic, I can do that easily through email. So please don't hesitate to reach out to me by email. We also have something called the Learning Center Dashboard. It is on SBA.gov. It is a learning center where we have a lot of pre-recorded seminars and webinars. We have some tools on there, some templates for financial statements and business plans. Lots of fantastic resources that are there free of charge, and you can get those at SBA.gov. All right. And that is it for my presentation. With that, I will turn it over to answer any questions you may have.
Okay, so we had some questions in the chat. Can SBA loans be used to purchase rental property?
Yes, but there's some caveat to that. So if you are trying to, for instance, if you're trying to purchase like a home for a Airbnb or something like that, or you are purchasing a building and your whole purpose for that building is to just rent it out and you're not operating any business yourself out of that building, then no, you can't, because SBA will consider that an investment property, and SBA guarantees cannot be used for investments. They have to be used for direct business purposes. So if that business purpose is strictly to rent out a piece of property that you're not operating a business yourself out of, or at least out of 50% or more of that space, then you can't. Now, again, that's not to say you can't get a loan. Lenders can provide loans all day long for things like that. They find them a little bit more risky, so it's a little bit harder, but they will do it. They just can't get the SBA guarantee for it.
Okay, thank you for that. And the other questions was, will you be sending out the PowerPoint? Yes, the PowerPoint presentation will be attached to the post-survey email sent after the live session.
Yes, I'll be sending that to you, Shrika, afterwards, and you can send it out.
No problem. So I'll go ahead and I'll take you to the SBDC training portal just to show you what we have to come. So this is our website. I encourage you to go ahead and select training, go down to the events tab, and this is where you'll be able to find what's to come. So this is the SBDC training portal, and we want you to know that today's presentation will be accessible in a on-demand format. And what you will do is when you reach to this page, you will select on demand, and when you search, it will appear here so you can watch at your leisure. So we have a marketing webinar available. Wayne gave a presentation on disaster preparation and mitigation for your business, and SCORE introduced their local team so that you can meet the mentors within the territory. So when you're looking for what's to come, you will always select live. Make sure center is on all so you get to see everything on St. Thomas, St. Croix, and St. John. So coming up tomorrow, the Agriculture Business Center will be hosting the Ag Marketing Webinar Series Introduction, and that's going to be from 6 p.m. to 7 p.m. On June 4th, we have a VBAC USVI and Puerto Rico team, and they're going to be presenting in the Introduction to Business Ownership. Those webinars start on Thursdays in June, and they're always starting up at 10 a.m. On June 10th, we're collaborating with the American Red Cross to bring forth Building a Resilient Enterprise, Disaster Preparedness for USVI Small Businesses. VBAC returns on June 11th with Understanding Markets and Your Competitive Space. We have our Business Resiliency Series starting on June 17th, and the first session starting at 11 a.m. is going to be Future-Proofing Your Workforce, Recruit Top Talent, Reduce Turnover, and Sustain Growth. And then VBAC takes back over on the 18th of June with the Economics of Small Business Startup. And then the last webinar within the Business Resiliency series is going to be Navigating the Unexpected, the Business Resiliency and Survival Experience. That's going to be on June 22nd, and that will be on Monday at 2 p.m. On June 24th, SBDC advisor Liza Margoles is going to be presenting on Digital Marketing 101, Boost Your Business Visibility on a Budget. And that webinar starts at 11 a.m. And then VBAC closes out the month of June with an introduction to business planning. So that's going to be June 25th. It's a Thursday, and it will start at 10 a.m. So let me go back and see if we have any more questions. Thank you for a great presentation, Wayne. And so I think that concludes all the questions that we have. So Wayne, it's always a pleasure collaborating with you on initiatives as such. And so on behalf of the entire VISBDC network, compliments of our State Director, Ms. Karen Jones, we thank you for your time and attendance today. Have a great day.
Thank you.